Hello and welcome to the ASC 820 2019 Guidance Update as presented by Carta. I'm Stephanie Wittrock. I'm a manager of 820 valuations here at Carta. And presenting with me today is Ben Tobin, who's a product specialist on our investor services group. So for anyone that is new to Carta, we offer a wide range of products and services. But in short, Carta helps private companies, public companies, and investors manage their cap tables, valuations, investments, and equity plans. So this is just a brief agenda on what we're going to discuss in the first half of this presentation. First, we're going to talk about the AICPA guidance and how it impacts 820 valuations. Then we're going to discuss what ASC 820 is, how to value a company for 820 purposes. Then we'll talk about some significant concepts that were outlined in the recent guidance. And lastly, Ben's going to cover what's new with Carta, ASC 820 self-service platform. Before we do a deep dive into the discussion, here's a quick word from our lawyers. This communication is on behalf of Carta Investor Services, Inc., Carta, an affiliate of eShares, Inc., doing business as Carta, Inc. This communication is not to be construed as legal, financial, or tax advice and is for informational purposes only. This communication is not intended as a recommendation, offer, or solicitation for the purchase or sale of any security. Carta does not assume any liability for reliance on the information provided herein. So the AICPA released a draft of this guidance back in May of 2018. We anticipated that the guidance would be finalized in May of 2019, but ultimately it wasn't finalized until the second half of August. But this is the first time that the AICPA has released guidance specifically geared towards VC and PE investors. It's a lengthy document. It's 14 chapters and 3 appendices, coming in around 600 pages. But it does provide very valuable insights into valuation methodologies, as well as just how to think about 820 valuations holistically. On that note, this is a good time to mention that at Carta we have 2 820 offerings. One of them is our self-service platform, which allows users to leverage our advanced cap table builder in running their own valuations using our valuation software. And our other option is to go with the 820 full service offering. In this case, our team prepares the valuations for your fund in line with your internal valuation policy and then defends those valuations to your auditors. So if at any point during this presentation you're just feeling a little bit overwhelmed, please reach out to us and we'll have one of our experts talk to you about maybe seeing if full service valuations is more appropriate for your fund. So ASC 820 is an accounting standard codification that requires that investors report their holdings at fair value. So this gets tricky with level 3 assets because these are assets that are not traded on an active market. And that's where ASC 820 valuations come in. So the first step in an ASC 820 valuation is to value the company itself. So there's 3 approaches that can be used to value a company. The income approach, or the DCF, is generally used for later stage investments. Companies that are either operating profitably or nearing profitability. The asset approach is generally used for early stage investments that have yet to receive external funding. So for these reasons, the income approach and asset approach, while they are used in 820 valuations, are less common than the third approach, which is the market approach. Under the market approach falls 3 methodologies. The subject company transaction method, which covers both the back solve and the post money. We were hoping that the guidance would draw a distinct line on which one of these methodologies was most appropriate, but it doesn't. And so we suggest determining which methodology is most appropriate for your fund and applying that methodology consistently across the fund. The second market approach methodology is the guideline public company approach, or the GPC. So there's a lot of attributes to consider when selecting a comparable public company. But some examples are the company's revenue size, their target market, their revenue model, things like that. So it's typically you're not going to find a perfectly comparable public company. So instead, we suggest curating a list of 5 to 10 reasonably comparable public companies to use in your GPC method. The guideline transaction method considers transactions, meaning acquisitions within the market. So similar to the attributes outlined in the GPC methodology, you should consider how the target companies are comparable to the subject company when making your selection. But also in this approach, it's important to make sure you're considering reasonably relevant transactions. So we suggest looking at transactions within the last 3 years. Once we've arrived at a company value, we allocate that value to the share classes to ultimately arrive at the fair value of the investment of the fund. So one way to allocate the company value is a waterfall, and the liquidation waterfall considers the rights and preferences of the different share classes when allocating the concluded company value to these different share classes. Another option is a common stock equivalent. In this allocation method, we consider all share classes as converted to common and allocate the value across those share classes. This methodology is typically used for companies that are nearing an IPO or if the analysis relied on post-money. The option pricing model, similar to the waterfall, does consider the rights and preferences of the outstanding share classes, but it also incorporates market volatility when considering a continuous distribution of outcomes for each breakpoint of the liquidation waterfall. And lastly, we have scenario-based methods, also known as the P-worm. So the P-worm focuses on distinct future outcomes and assigns probabilities to each of those future outcomes. So it considers both the future exit date and future exit value of the company and assigns weightings to each of those possible outcomes and allocates that value to arrive at the share class value. So now we're just going to touch on some significant concepts that were covered in the guidance. So the first topic I want to touch on is market participant assumptions. Whenever valuing a company for 820 purposes, it's really important to consider how a market participant or investor would value the company. For example, whenever possible, the guidance suggests that you should rely on a transaction within the subject company's shares, assuming that it's arm's length. And you should be reviewing the details of that transaction and trying to understand what the key metrics were that drove the pricing that investors ultimately paid for that investment. So understanding these metrics is necessary for calibrating the subject company transaction at a future valuation date. And just generally assessing how the company has performed relative to how investors expected it to perform. You should also consider whether a market participant would actually pay the price that you're arriving at, just sort of as a reality check to make sure that you're arriving at a reasonable indication of value. So calibration, I mentioned this briefly when talking about market participant assumptions, but essentially calibration should be used to adjust the value implied by a subject company transaction to reflect both changes within the company and changes within the market from the close of the transaction to the valuation date. Due to the delay in the finalization of the guidance, a calibration model will not be supported by the Selfservice platform for Q4 2019 valuations. But it is available for our full service clients. For control premiums and DLOCs, or discounts for lack of control, the guidance generally advises against them. It's reasonable to assume that minority and controlling investor interests are aligned in ultimately receiving the most return on their, or the largest return on their investment. So generally speaking, DLOCs and control premiums are not recommended. As for discounts for lack of marketability, or DLOM, you'll need to reference your internal valuation policy in determining whether you should apply DLOM in your analysis. Backtesting essentially asks that you compare actual exit values within the fund to the value that you were holding that investment at prior to the exit. And this exercise is really meant to provide you insight into how accurate your valuations are and help you identify any areas that your valuation policy may need to be adjusted. And now Ben Tobin is going to show you what's new with our ASC 820 self-service tool.
Hi, my name is Ben Tobin, and I'm a product specialist on the ASC 820 team at Carta. For this section, I'm going to introduce the structure of our self-service tool and walk through a valuation for Krakatoa Ventures, our demo VC. Now, if you're more comfortable with a third party handling your valuations, we have a team on staff with over 40 years of combined experience that can manage the entire process for you. So what we're looking at right here is the homepage for the self-service tool, which we've broken down into 4 different layers. Review details is where you'd enter or confirm the inputs that are going to feed into your valuation, and this includes cap table, financials, and market data. Value company is where you'd pick and build out the methodologies that you'd like to use. Value shares is where you confirm the allocation model that you'd like to use, and if recommended by your investment policy, apply a discount for lack of marketability. And finally, complete valuation is where you get a chance to review your work and generate a PDF. So for Krakatoa, we're going to be looking at their company FaceFriend. FaceFriend raised their Series A in early 2019, and we're going to be looking at that transaction as well as their revenues as indications of value. So starting from the top, we're going to want to confirm their cap table data that will be used in this valuation. And if the company is managed on Carta, all of this will dynamically update as issuances occur. And if there was a round of preferred in discussion that you wanted baked into your valuation, you can leverage our pro forma tool to include that. And for financials, we've distilled this down to the 4 line items that are most relevant to venture-backed companies. On the balance sheet, we're looking at cash and debt. And on the income statement, we're looking at revenue and EBITDA. And for our market data, we have an integration with Capital IQ that refreshes every 15 minutes. And we've included 3 different tools to help you select your comps. If there's a specific ticker that you have in mind, you can enter that or the company name right here. And we've also included this library of industry baskets. So if you select FinTech and add that in, it will return a table with companies whose profile matches the description of that industry. And if you wanted to dig a little bit deeper into Capital IQ's database, we've included this algorithm where you can enter a handful of keywords that represent your company, and it'll return a list with similar matches. And for this exercise, we're going to be using a comp basket for volatility distribution and revenue multiples. So we can keep the broader list for the volatility, but trim it down so our revenue multiples are closely aligned with the company we're looking at. We can uncheck this box in the top right and handpick the comps that we want included in the revenue analysis. When picking a methodology, you can manually weight any of the 4 that we support. And we also have this guidance up here that will prioritize the recent preferred transaction as an indication of company value, and then proportionally weight the guideline public companies method as you stray farther and farther away from that preferred's closing date. And to complete the back solve, we'll need to enter or confirm the inputs for the option pricing model, which includes volatility, as well as confirming the round that we'll be back solving for. And for the GPC method, we'll need to enter the revenue multiples that we'll be applying to each period and including our weighting strategy. And to help provide some insight for your multiple selections, you can review all these key metrics that will feed into the project, as well as this ranking table, which will line up the company you're valuing against your basket of comps within each of the categories in the top row. To select your multiples, we can rely on a percentiles approach. And we'll go with median for this exercise. And within the conclusion window, we'll apply our weighting strategy. And so we can provide some support for our multiple and weighting selections in the final PDF we generate. We've included these 2 text boxes where you can enter any language that you'd like to explain your selection. And we've also included some suggested text for common selections. And here we'll select the allocation model we'd like to use. And if you would like to include a discount for lack of marketability, we support both the chafe and affinity calculations. And the final step in this project is to allocate. And once we've completed our calculations, before we generated the PDF, if we wanted to have any quarterly or annual performance documented in the report, you can enter that here and it'll all flow through. As we scroll through the PDF, you'll see that it includes a summary of your holdings, as well as the financial, cap table, and market data that fed into your valuation. And we've also included the industry language to support the methodologies, as well as the inputs that fed into them. And that concludes the tour of our 820 solutions. If you have any further questions, we'd love to speak with you. Please visit carta.com, where you can immediately schedule time to talk to an expert. Thank you very much.